a lot of the investment research dedicated toward retail tends to be sensationalist, generally low quality. And so one of my approaches was to basically, take institutional research and put it into plain English. And the funny thing is, institutional people appreciate that too. So it's not just taking institutional and giving it to retail. It's taking institutional and then just covering in plain English so that both, relatively sophisticated retail investors can make use of it, hopefully, and then institutional researchers, they find certain angles differently, especially if you have a fresh lens. Like my lens is through that engineering perspective. It's kind of a different way of looking at things compared to what they might find, other people write in that field. And, you mentioned Neil Howe. I actually found his research very useful as well. One of the things I try to incorporate, because I found it to be very useful in this environment, is that super long-term perspective, even though it's generally past an investment horizon. But the way I treat that is looking for things that deviate from the normal cycle, right? Mm-hmm. So when you have these kind of like larger, what he would call a fourth turning, these larger events, I find that very useful, and I've kind of actually combined that with Ray Dalio's research on the long-term debt cycle. Mm-hmm. About 5 years ago, I was trying to get my mind around where this kind of macro environment was headed in kind of the generational sense, right? I was kind of asking big questions like, what happens when this debt gets to unsustainable levels? How is this resolved? And, I saw Ray Dalio's research, and he pointed back in history, and I ended up doing a deep dive in that whole period. The last time we had, sovereign debt levels this high in the developed world. And so I kind of also have those multiple different time frames. It's just that my average time frame is obviously further out than your average time frame. Yeah, that's a challenging question, I think, off the top of my head. But basically, for me, the two kind of points that I found useful is combining some of that Ray Dalio long-term debt cycle with Neil Howe. It's almost like you get the quantitative view and then the qualitative view kind of put together. I think Luke Groman covers, some of that long-term stuff very well. Also, kind of these big pivotal events. And I generally find that there's no one analyst that I follow for any one thing, but I kind of piece together what I think people are strong at, and then try to find someone else that covers what they might be weak at, including my own weaknesses. For example, I don't cover anything in the healthcare sector, really. I can't differentiate, different types of healthcare companies, so I have to look out at people that I think cover that better than I do. I might have a macro view of that space. I might have a valuation view of that space, but I don't have any knowledge on pharmaceuticals. And the same thing is true for when I cover geopolitics or these kind of bigger things, where for me, I take a very quantitative approach. I like to go to the raw data, but then I combine that with other people that help me interpret it. Cash and safe assets on bank balance sheets relative to their riskier things like loans, things that can actually default. And obviously they did run into a default event, so they risked their whole bank capital getting wiped out by these series of defaults. And it looked in many ways very similar to the 1929 crisis in terms of, say, how much bank loans were outstanding relative to the monetary base. These kind of like these big generational charts in the quantitative data. And so that whole, the 2008 crisis and the 2010s aftermath are in many ways very similar to the 1929 crash and the whole 1930s aftermath, which is, going back to Neil Howe, that's, basically the fourth turning type of environment. This one's different in the sense that it's at least so far, there are certain pockets of credit risk, but the main thing hitting banks is that they invested in very safe assets, but at wrong prices, and now they're facing their deposit rates going up. They're facing unrealized losses, and then they have a challenge where they can hold those assets to maturity, but the market doesn't always let them do that, especially if they have deposit runs and things like that. So earlier, last month there was a liquidity crisis. Now I think it's evolving more towards a profitability problem because, while the Fed and others have these facilities in to prevent ongoing liquidity, or at least reduce the severity of some of these ongoing liquidity problems, banks now face an issue where, they have some of these long duration assets that might be relatively safe, and many of them are, but then they have rising deposit costs overlaid on top of that. And if you look at the Federal Reserve's own balance sheet, I mean, they're in the red. They're operating at a loss now because their liability is adjusted upward very quickly. That's a policy they decided to do, and essentially we're seeing the slow motion version of that happen to the commercial banking sector, where their deposit side is slowly kind of catching up with a big lag compared to where the Fed's own rates are. And you see that more so happening in the long end of the medium and smaller banks, whereas larger banks have more overall position to not really raise rates as quickly because everybody wants an account at those bigger banks. And so right now there's a kind of, I think, an ongoing profitability problem among those small and medium-sized banks. And then it's obviously further exacerbated by some areas of actual credit concern, things like autos, things like commercial real estate that are well-known issues at this point.